Well, we're beginning reading 43 right now, which is Portfolio Risk and Return, Part 2. We've already done Part 1. Part 2 is quite simple. If you really understand Part 1, if you don't, Part 2 is going to be, I'm going to lose you. I know that. If you really get Part 1, if you really want to get Part 2, do extra work on Part 1, and as we go through Part 2, you'll go, that's it? I can extend that easily. I don't have to do any more problems. I get all that. So the work you do in Part 1 pays dividends in Part 2. So we're going to cover off two learning objectives at the same time, LOSA and LOSB. They're hard to pull apart. Keywords here: describe and explain. A, describe the implications of combining a risk-free asset with a portfolio of risky assets, and we've come a long way on getting to that point, and we're just going to tighten it up here. And B, explain the capital allocation line and the capital market line. Well, that's new, the capital market line. And we're going to see that the capital market line is really just a special case of the capital allocation line. So let's sort of put this in context so you can see where we're going. In the last reading, what we were doing was we were attempting to find optimal portfolios. So we took a number of risky assets, whether we took 2, 3, 4, 5, whatever the case is, and we constructed risky portfolios, or portfolios of risky assets. Let's not call them risky portfolios. Portfolios of risky assets. And we found that we could find, for any combination of risky assets, we could find a minimum variance frontier that kind of looked like this, where we had a global minimum, but we know that if we combine it with a risk-free asset and drew a line tangent to the efficient part of the minimum variance frontier, that we could achieve the same return as the global minimum by simply walking up to the capital allocation line and combining a riskier weighting on the portfolio here. A has different weighting, so it's riskier than it would be at the global minimum. We can combine that with the risk-free rate and get a higher return for the same risk. And as we look at B and C, we notice that, well, okay, B has a higher return, but it also has higher risk. C has a higher return, but it also has higher risk. And maybe these are all efficient portfolios on their own minimum variance curves. Which one do we take? Well, the argument was quite simple. You would take the one with the slope of the capital allocation line, or the portfolio that lay on the capital allocation line with the highest slope. Reason is if we were down here, we don't like this much risk up here. Don't like it. But here's the deal. If we decided that we were going to be at this point, we could simply say, well, you know what? I'm going to go for portfolio C and combine it with the risk-free asset, just use different weightings, and I'm going to walk myself up to that point on the curve. Now I got higher return for the same risk. So we want the line, the capital allocation line with the steepest slope. That was called the optimal capital allocation line. That's where we've been. So A, B, and C. These are portfolios of risky assets. They lie on the Markowitz efficient frontier of their own respective minimum variance frontiers. The CALC, the capital allocation line C, is the optimal capital allocation line. Anything, and if we're on this line here, there's 100% in C, here's 100% in the risk-free rate. Anything between RF and C is called a lending portfolio. Why? Because we're holding some combination of the risk-free asset and the risky asset, which means we're lending some money to the government. So look at portfolio X. We can think of an individual with an indifference curve that looks like this. And let's say that their A coefficient was 4 in this particular respect. So they would hold some combination of C, they take the market index and weight it something less than 1, and take the risk-free rate and weight that something less than 1, and there they are. And that is a better place to be than combining B with the risk-free rate or combining A with the risk-free rate. We're on the optimal capital allocation line. Point Y, on the other hand, is beyond 100% weighting on C, so we must be borrowing money to invest in that. So we can conceive of another investor with an indifference curve, perhaps with an A coefficient of 2, that is more risk tolerant and willing to take on more risk at that point in time. So there we are with kind of a good review and an idea of what we're doing here now. Let's just do one more thing before we move on. I want you to have this firmly in your head, but I want you to see a relationship that maybe I didn't make so clear before. Let's take portfolio A here, and let's see if we can derive the slope of this line without knowing what the formula was. Remember, we were able to calculate the expected return on the portfolio equals some intercept plus the slope times the standard deviation portfolio. Well, let's just go back to grade 9 and pretend we don't know anything about finance and ask somebody in grade 9, how would you calculate the slope of that line? And they would say, well, that's very simple. You just do this, and the slope of the line is rise over run. Remember that? Rise over run. Well, what is the rise? All we have to do is extend this out to the line. That's the expected return on A. So the rise is just the difference between where the curve where the line started and where it ended. And the rise is nothing but ERA minus RF. Those are the two intercepts on the horizontal, or on the vertical. Over the run. Well, here, what is this? This is nothing more than the standard deviation of A. This is 0. So the run would be the standard deviation of A minus 0, which is nothing more than the standard deviation of A. Well, you'll recall in the last reading, we were able to calculate the expected return on the portfolio using the capital allocation line by writing the function. What does the capital allocation line look like? What's the function of it if I wanted to draw it? Well, it has an intercept of RF, plus it has a slope of ER, and we'll just generalize to any asset, minus the risk-free rate over the standard deviation of I times standard deviation of the portfolio. There we go. So if you forget this formula, just say, well, hang on, I can derive it. I know that the intercept is the risk-free rate. The slope is, what is it again? Well, go back to grade 9. It's rise over run, and just fill it in. And, of course, it's a function of the standard deviation of the portfolio, right? So before we push on, I want to sort of pose a question. And I'm going a bit slower in this reading than the curriculum does. I find that the chapter on this reading assumes that you've already got a lot of knowledge and that this is just a really good review. And if you didn't do well in portfolio management, or you never passed through portfolio management, a lot of the detail can be lost. So this is where we left off on the last screen. These were our 3 portfolios that we chose, and we were able to choose the optimal capital allocation line, which lay on point C. So we know that, listen, if you've selected A, there's no point in staying with A. Maybe you like that risk-return trade-off, but you can walk up to this capital allocation line and combine a riskier portfolio with the risk-free rate to bring your risk down to the same level as A and get a higher return. Great, we know that. Well, if you continue
this exercise, the logical next question would be, well, what if there's one on a higher curve and we just haven't done enough work? And what if there's one on another yet even higher curve? If I went to another investor who did their work and we both looked at our capital allocation lines, would they have the same line as I, or would they have a steeper one? Would I not try to search out there and say, hey, who's got the steepest capital allocation line, and do you mind sharing the constituents of that portfolio with me? And even at the professional institutional level, which runs money for people, don't you think that they would have figured that out as well? Don't you think that there'd be one portfolio out there that everyone has centered on and said, aha, here it is right here. Here's the one that has the steepest capital allocation line. And we just try to get this as steep as we can. Can't get any higher. Computers have run it and can't get any higher. That's the best we're going to get. Wouldn't everyone just take that? Because it seems that, look, seems rather juvenile. We just plot a bunch of points and draw a line through the steepest one. Period. What do I need all these other ones for? Well, that's a good question. And it requires to buy into that one optimal portfolio requires an assumption we make about investors. And we're going to get to that. So this assumption is called the homogeneity of expectations. And that assumption says all investors have the same economic expectations. And if they have the same expectations, that implies, i.e., that means the same expectations regarding the risk-return distribution for each asset. Because remember, what do we need to be able to determine what constituents we want and what weightings we want on assets in a portfolio? We need two things. We need the expected return of I, and we need the standard deviation of I. The expected expectations. If everyone has the same expectations, the same economic expectations, everyone should arrive at the same expected return given that level of risk. If that's the case, there would be only one optimal risky portfolio. Do you believe that all investors have the same economic expectation? If you do, then there is one optimal portfolio out there, and your job is to find it, and once you find it, you're done. Your investing career is over. You found the optimal portfolio. At that point, all you need to do is follow a passive strategy of saying, I'm going to combine it with a risk-free asset, and I'm simply just going to change my weightings depending on how my expectations of the economy change. I think we're going into a bad situation. I'll switch more into the risk-free asset. I think we're hitting to growth. I'll switch more to the risky asset. And that would be it. Investing would be simple. There'd be one big, fat, concentrated position in the market, and it would be called the optimal portfolio and the risky asset. There'd be no need for anything else. If you don't believe in the homogeneity of expectations, if expectations are not homogeneous, there are multiple optimal risky portfolios. Let's take a look at that before we finish this last point. So let's look at our two investors side by side. Here's our original investor who's looked at certain assets, combined them into a portfolio A, looked at other assets, combined them into B, looked at other assets, made another portfolio C, followed the theory, drew their lines through their points, found the steepest line and said, all right, I'm going to use asset C with the risk-free rate to make up for A and B. So why B and B when I could just do this? Combine C with the risk-free rate, have the same risk as B, but get a higher return. Done. Let's look at our other investor. Our other investor is faced with the same risk-free rate, agrees with A, says, I think you're absolutely right on A. We're the same there. But B and C, my friend, you are way off. You have assets in B that you have not recognized are clearly undervalued. My expectation is for a higher future value, so I have a higher expected return for the same risk. But asset portfolio C, you've got assets in there that are clearly overvalued. I think their return will even be negative or very, very small. So I'm going to place asset C over here. I have different expectations. So suddenly, my capital allocation line The steepest one that offers the steepest slope goes through B. And remember, the slope of this curve is the market price of risk. The market price of risk. So you want the steepest slope that you can get. Why? Because for every unit of risk that I take on, I get a higher level of return. A higher level of return. The flatter the curve, it means I have to take on a lot of risk just to get one extra unit of return. Here, it's smaller. So I want the steepest line. Mine goes through optimal portfolio B. Yours goes through optimal portfolio C. We'll see who's right. At the end of the year, we'll see who's right. So if you buy into the homogeneity of expectations, there will be one optimal risky portfolio for everyone. That implies a passive investment approach. If you believe that people have different expectations about the future, suddenly, if I do my homework, I can have better expectations than you. I can have a better estimate of what expected return is than you, because maybe I'm better at this than you. At least that's the belief. I would never engage in active investing if I thought, you know what, I'm not that bright. I can barely walk and think at the same time. I would never do active investing. Clearly, I'd do passive. Well, probably I would do active investing, because if I were that thick and that stupid, I would be too stupid to know that I couldn't do it. Yeah, there we go. But I'd only engage in active investing if I believed that I had a better ability to forecast future returns. In which case, I would have a different portfolio. This is active. This is passive. If you buy into one optimal portfolio, you're a passive investor. If you think you can do better, you're an active investor. So we finished our first point about the homogeneity of expectations. Let's look at another assumption. Markets are informationally efficient. They are informationally efficient. If we think they are informationally efficient, it means that the price that we see in the market is the best, unbiased estimate of that security's intrinsic value. So how would we weight that asset in a portfolio? Well, we would weight it, if we think the price is the unbiased estimate of its intrinsic value, it would be the price times the number of shares divided by the market value of all the assets in the portfolio. So it would be weighted in proportion, its market share, in proportion to the market share of the whole portfolio. There'd be no excess return to active investing. There'd be no point in overweighting this particular element, because you believe that the markets are informationally efficient. Now, these two things may sound like the same thing, but they're not. The first one, homogeneity of expectations, will change your estimate of expected return. This one changes your expectations, or changes what you would weight the particular asset at. If you buy into both, then you're a passive investor. If not, active investing may deliver some excess return. Does it? I don't know. I've already put a video in called How to Win the Loser's Game in another playlist that really questions active investing and if it does actually work. And the answer is, from the evidence that they've compiled, the answer is not really. No, it doesn't. That the vast majority of investors would be better off holding a passive index fund with some combination of the risk-free rate. That's for you to decide, but that sort of fits into what we're talking about here. So let's put that out there as questions, and then as we work our way through, you'll decide whether active or passive has merit on either side. So we have used the term market portfolio quite a bit without actually being specific about what we mean by the market portfolio. And if we are going to talk about the optimal risky portfolio, it really depends on our definition of what the market is. So let's define it. Typically, we would say the market includes all assets that are investable and tradable. That's huge. That's a huge amount. So we tend to limit it to a country's major equity index. So in the U.S., that would be the S&P 500. We would use that. That represents about 80%
of market capitalization in the U.S., by the way. So we would say that's a good proxy for a market portfolio. That becomes the optimal market portfolio. So if we look at what I've done here, I've placed M on the efficient part of the minimum variance frontier. And here's our risk-free rate, and of course a straight line that is just tangent to the minimum variance frontier will find our optimal portfolio. That's the optimal portfolio we want to take, and we will take that in some combination with the risk-free rate. This line, you'll remember, when we drew this line that was just tangent to the frontier, we called it a capital allocation line. Well, now we're going to call this the capital market line. And the capital market line is really just a special case of a capital allocation line. It is a capital allocation line where the risky portfolio, or the portfolio of risky assets, is the market portfolio. And M is the optimal risky asset portfolio given homogeneous expectations. So we went through that discussion earlier. It is the optimal risky asset portfolio given homogeneous expectations. So if we were constructing a passive investment, there's our optimal portfolio. If we don't agree, if we say, no, there are not homogeneous, I have different outlook. I have a much different outlook. I don't think things are as good as what everyone says they are. In fact, I think they're downright awful. I might have different expected returns on those assets. Well, that will create different weightings. I will have a different optimal portfolio. But I'll still have a market portfolio. It'll be different. I'll still have a capital market line, but it'll be different from yours. Anyways, there is the market portfolio as it's given to us in the market, plain and simple. Below it here are all the individual securities, so that any combination of these will be inefficient because it won't get us to the efficient frontier. Only all of them together will get us onto that minimum variance frontier. So let's look at what we have here. Here's our capital market line. The slope of this line, we've already looked at what the slope is. To estimate our expected return on any combination here, we know it is the risk-free rate plus whatever the slope of this line is times how much risk we're taking on. So we can determine what level of risk we're comfortable with, and that will dictate our return. It will also dictate whether we have a lending portfolio or a borrowing portfolio. Now notice that the slope of the line uses the expected return on the market portfolio minus the risk-free rate. Well, what is that in the numerator? That's the equity risk premium. The equity risk premium divided by the standard deviation of the market. So it's a risk-adjusted return on the market, multiplied, of course, by the standard deviation of the portfolio, because our return on the portfolio is a function of the risk we're willing to take on. This whole term is called the market price of risk. We truly have it now. The return on the market minus the risk-free rate, the equity risk premium, that's the market price of risk. Well, let's put this to work, and let's see if it can help us do anything. Over here, you see that I have my risk-free rate on the intercept, and my risk-free rate, I'm saying we're confronted with a 5% risk-free rate here. I have my minimum variance frontier. I draw my capital market line just tangent to that, and where it is tangent creates a point. That will be our market portfolio. Here we have a expected return of 15% with a standard deviation of 20%. And from this, what we want to do is we want to look at what happens when we change our weightings on these. So what I want to do is I want to show you how this works right along this line here. And to do that, let's first calculate the market price of risk, which is just the slope of the line. So the expected return on the market minus the risk-free rate divided by the standard deviation of the market gives us 0.15 minus 0.05 or 0.2 or 0.5. So what does this mean? How do we interpret this? Let's be clear about this first. That means that if we increase
the portfolio risk by 1 unit, the return would increase by 0.5 units. Now, I want to be very clear here because there's a trap of falling into these deterministic relationships, thinking that this is a solid relationship. This is an expected return based on the level of risk. And everything that got us to this point was built on a foundation of probability, not certainty. Nowhere in here is there certainty. This is all still probabilistic. So probably if we assume more risk, probably we would squeeze out 0.5% more return, probabilistically speaking. So let's be clear that we're still, even at this level, we're on the top floor of the building, but we built our foundation on a foundation of probability. This whole structure we're building is all based on probability. So that doesn't mean that's what we're going to get. It means that's what we think we're going to get based on everything we've done so far. Okay. So every unit of standard deviation delivers 0.5 units of expected return on the capital market line. So I'm going to show you how this works, and we can do it in a very quick way, and then we'll do it with the formula just to show what's going on. Let's say we're 100% in the risk-free asset over here. And 0% in this particular asset. What is our expected return and standard deviation? Well, that's just the risk-free asset. We know that's 5%, and the standard deviation of that is 0. Nice and simple, right? Well, what if we were at the bottom here and we are not in the risk-free asset and we're 100% in the risky asset? Well, then it is just the characteristics of the risky asset that apply, which would be 15%. And 20%. So if we know the market price of risk at 0.5, if we were 50-50, if we're going from 0 to 10, if we were 50-50, we could just say, well, that's 10, and we're going from 5 to 15, the distance is 10, we're going to cover half, it should be 10%. And we're going from 0 to 50, if 25 is in the middle, it should be half that distance at 5%, which would make this at 15% because that's halfway through. Halfway between here should be 7.5%, and halfway between here should be 12.5%. So if we know the slope of the capital market line, it's easy to find any return and risk combination. It's easy. We don't really have to use the formulas. But if we did, let's use the 75-25. If we weighted asset 1 at 75 at 0.75 multiplied by 0.05 plus 0.25 multiplied at 0.15, you would get 7.5%. If we tried to determine the standard deviation of the portfolio using this particular function, we would get 5%. And just a brief note. Why is the standard deviation of the portfolio just this? We've been through this, but just as a refresher, I'll explain. Remember, the first term was W01 squared, the standard deviation of the first asset squared. Well, the first one is the risk-free asset. It has a standard deviation of 0. So the first term just cancels right out altogether. The second term was 1 minus W1 squared, standard deviation of the second asset squared. That stays. The third term was 2 times the weighting on the first, weighting on the second, times the covariance of the two returns. Well, because this has a standard deviation of 0, by definition, its covariance will be 0. That term cancels out. So the variance of the portfolio was equal to 1 minus W1 squared and the variance of the second asset squared. So to cancel the square, you just cancel the square. What are you left with? There we go. Just a quick one to show you how we got there in case you forgot. So if you take each of these, the standard deviations and use the weightings on W1 in here, you will get exactly this. So you can rely on the formula, but once we know the slope of the capital market line, we can just use that directly and solve for anything. Now, everything we solved for lies in between 0% on the risky asset to 100%, all along this line.
Well, let's take that same scenario, and this time we're going to use leverage. We're going to use leverage at 25%, 50%, and 100%, and we're going to create a borrowing portfolio. So at 25%, let's solve our problem here. At 25%, we're going to use 25% leverage, which means we're going to borrow at the risk-free rate. So our W1, which is how much we have in the risk-free rate, is now going to have a negative weighting, negative 25%. Our W2 will now be 125%. So let's see if we can't solve this. We just figured out our expected return. Our expected return on the portfolio will equal negative 0.25 times 0.05 plus 1.25 times 0.15 equals 17.5%. The market portfolio returns 15%. We've used leverage. We're getting up to 17.5%. What happens to our standard deviation? Standard deviation of the portfolio. Well, if we're up here, we should expect it to be higher than the 20% we're currently getting right now, right? So it's just 1 minus W1 times the standard deviation of 2, which is, what do we have? 1 minus, and W1 is negative 25, negative 0.25. 1 minus negative 0.25 times 0.2. Well, that's 1.25 times 0.2, which is 25%. So yes, we can leverage and we can get higher than the market portfolio on the capital market line, but it will come with proportionately more risk. What about 50%? Can we calculate one for 50%? Well, we can. Our W1 in this case is going to be negative 0.5. Our W2 in this case will be 1.5, as long as they add to 1. So the expected return on the portfolio is going to be negative 0.5 times 0.05 plus 1.5 times 0.15, which will give us 20%. The standard deviation of the portfolio is 1 minus negative 0.5 times 0.2, which will be 30%. Fairly straightforward. The last one, if it were 100%, let's just get our weightings down. Our weighting on number 1 would be negative 1. Our weighting on asset 2 would be 2. So the expected return on the portfolio is going to be negative 1 times 0.05 plus 2 times 0.15, or 25%. Plugging the same numbers in for our standard deviation of the portfolio, we're going to end up with 40%. So the capital market line can stretch on and on and on. We can use as much leverage as we want to push ourselves further up this curve, depending on our risk profile. So, to recap, what do we have here? We have one risky portfolio, M, and a risk-free rate. And we can choose how risky we want to be by either lending or borrowing. So we don't have to go around looking for a bunch of assets to create a certain amount of return. We don't even have to do that. All we have to say is, look, this is going to be really easy. I got a well-diversified portfolio here, the market index. Why should I even try? Why? The work is already done. Now, if I'm trying to target a specific return, all I have to do is say, well, where's the return I'm trying to target? Up here? Well, let's come across here. There we go. There's where I should be on the capital market line. How much leverage do I need to get there? I'll borrow here at the risk-free rate, invest in the portfolio, and leverage it up to that amount, knowing that I am, of course, taking on, what a terrible line there, eh? Knowing, of course, that I am taking on more risk at that point in time. But if that's what I was looking for, I don't have to go looking around anywhere else. I can do it all with two assets, the market portfolio and the risk-free rate. I can do it all with two assets. So I can find my position anywhere on here, depending on how risk tolerant or risk averse I am. That's all I need. Job done, right? Well, let's look at lending and borrowing here. We can in our lending portfolio, we can lend at the risk-free rate. So that creates this type of slope, as we show over here. But now we have to borrow at 7%. We can't lend at 5%. We have to borrow at 7%. Well, that's easy enough to do. All we have to do is let's just pretend that the risk-free rate was 7%, and let's just do the line again. So if this is 5% and this is 7% over here, if that's 5, let's say that's 7% right there. All we need to do is draw the line. So let's anchor our point. Let's go over here, and there we go. We don't draw the first part because we can lend at 5%. We'll just draw the second part, which is what we have to borrow at. There we go. And to determine the slope of that line, we'll just assume that the line extends all the way down to the line. And how do we do it? Rise over run, right? So what is the slope of that line? It is the expected return. If we take this point over here and we extended this down to here, it is just the rise over the run, the expected return on the market minus RB. Not RF, not the risk-free rate, but the borrowing rate. We're just going to substitute the borrowing rate in, divided by the standard deviation of the market. And since we already know what those are, we can figure this out. We know that the return on the market was 0.15 minus, we're not going to subtract 0.05, which is the risk-free rate. We're going to subtract 0.07 at this point. And we're still dividing it by the same standard deviation, 0.2, which means 0.40. So now we're only getting paid 0.4% in units of return for every unit of variance we take on. Our payoff just got lower, as it should be, because our cost of funds just got higher. So we can continue this on. What is our expected return on the portfolio? Keep in mind now it's going to be different, right? It will be the weighting on the expected return B, ERB. Why? Because we're borrowing. Remember now we're constructing a borrowing portfolio. So up here, our expected return cannot be a function of the risk-free rate. We're going to be weighting how much borrowing we're doing. And of course, W2 will be the expected return on the market. And of course, our variance is still going to be 1 minus W1, the variance on the market. It doesn't change. Just because we borrow at 7% doesn't change the volatility on the market portfolio. The market, as far as volatility is concerned, doesn't care what we can borrow money at, doesn't know what we can borrow money at, and it doesn't change anything. It just really doesn't change anything, so it stays the same. So let's say that we're going to borrow 75%. So in other words, our weighting on 1, RB, will be negative 0.75, and W2 will now be 1.75. So what is the expected return on the portfolio? We know we're creating a borrowing portfolio, not a lending portfolio. Let's write that in so that we know that this is, of course, the borrowing portfolio. We know we're creating a borrowing portfolio. So let's, expected return on the portfolio will equal negative 0.75 times, we're going to use RB here, 0.07. If we were lending, this would be positive, would have a positive weight, and that would be 0.05, right? Plus, the weights have to add up to 1, so if that's negative 0.75, this must be 1.75, and of course the same 0.15. 21%, and the variance on this portfolio will still be 1 minus negative 0.75 times the standard deviation. You'll still get the same standard deviation, 35%. Versus if you could borrow at the risk-free rate, your expected return on the portfolio would be 22.5%, and your standard deviation of the portfolio would be 35%. So notice that the standard deviation is the same, 35%. It's the same. You're creating the same portfolio in terms of risk. It's just that your return is going to be lower because your cost of funds is higher. We're moving on to our next learning objective now, LOSC. Keyword here is to explain. Explain systematic and non-systematic risk, including why an investor should not expect to receive additional return for bearing non-systematic risk. And this really goes back to a pretty influential paper that was written back in 1968 called Diversification and the Reduction of Dispersion. Evans Archer paper in 68, Journal of Finance. And if you're doing a PhD, you'll probably recognize, or even a master's level, a research master's level in finance, that is basically required reading in portfolio management and portfolio theory. And the argument ran like this, and what they did was they did something called naive diversification. And what they did is they took two stocks and put them together to see what kind of reduction in variance you would get. So let's say that this is what will be variance in terms of two different types, something called non-systematic risk, which is diversifiable, and they showed that even naive diversification can reduce that type of risk, and systematic risk, which is non-diversifiable, or what is called market risk. So, to be more formal, non-systematic risk, diversifiable risk, pertains to a single company or a particular industry. And it is diversifiable by creating a portfolio of assets that are not highly correlated with each other. You can get rid of all of this idiosyncratic or non-systematic risk attached with each particular equity. The portion you can't get rid of is the systematic risk, or what is called the market risk. Now, the market is that one factor that affects all equities. So you can't get rid of it. You can manage market risk, but you can't diversify it away. It's not that you can't get rid of it. It is non-diversifiable. You can still manage market risk. You can either get more exposure to market risk or less. You can get more exposure by using leverage. You can leverage a well-diversified portfolio of assets. You got greater market risk. The market risk affects the entire market or economy. So things like interest rates, inflation, economic cycles, geopolitical uncertainty, etc. So we can break total variance, this is what we have on the vertical axis, into two components, a non-systematic component and a systematic component. So we can call non-systematic risk, we can call non-systematic variance, and systematic risk we refer to as systematic variance. So when we take one particular asset and we measure its variance, what we're measuring is total risk. Well, some of that variance pertains just to the stock itself, and some of that pertains to the fact that it's part of a bigger market. And if the market moves, it's going to move that particular asset, whether there's something with the particular company or not that warrants the movement. If the market moves, it's going to take it with it. So that was the paper. That was the sort of the conclusion from that paper. And the big conclusion was, when we talk about the number of securities, this paper in 1968 suggested you needed anywhere from 15 to 20. Once you got to about 15 to 20, the addition of more really didn't help. In early 2000s, 2001, there was another paper that appeared in the Journal of Finance revisiting the 1968 Evans-Archer paper. And it found that there was an increase from 68 to the time they studied. There was an increase in firm level volatility versus market volatility. So they said, you know what, that 15 to 20, that doesn't work anymore. You're gonna need a lot more. And they suggested around 50 different assets, different stocks that are not very highly correlated together in a market portfolio to get down to the level of systematic risk. So now that we kind of understand where systematic and non-systematic risk sits in the variance of a particular asset, let's sort of start prepping up for our next learning objective, and we'll finish a bit up here. Let's assume we receive a return for both systematic and non-systematic risk. Because that's how we get our return. It's a function of the risk we're willing to take on. So if we take an equity, we take the total risk. It has both systematic and non-systematic components in there. Let's assume for right now that we're going to get paid for both, for total risk. We're also getting paid for the non-systematic risk, but since this risk is diversifiable, here's a free ticket, right? We can buy assets with large amounts of non-systematic risk and simply diversify it away. There we go. So we're getting return for free because we can get rid of that risk. We can diversify it. We get paid for risk we can avoid. So all investors would begin to do this, right? This is the logic of this argument, that if you got paid for it, you would do it, you would diversify it away, but so would everyone else. Well, all of that activity, what would happen?
can you think of the end result here? The demand for diversifiable risk would increase, obviously, driving up the price of assets, thereby reducing the potential return. So if you reduce the return, suddenly you're not getting a return for that non-systematic risk because it's been bid up. All that's left is systematic risk. Therefore, no incremental reward can be earned for taking diversifiable risk. So, if we're attempting to determine the expected return on a particular asset, the only risk that matters, as far as this argument is concerned, is systematic risk, not total risk. But so far, when we've looked at a particular asset, we know how to measure its total variance. But that total variance is made up of two components, systematic and non-systematic risk. And we're told that, look, you can ignore non-systematic risk, you're not going to get paid for it. So how do we determine a return for an asset that we're only going to get paid for part of the variance and not the other part? How much variance then? How do we measure that component of the variance that we should pay attention to? And how do we measure that part that we simply should ignore? That is the basis. That's the question underlying our next learning objective. So before we go, let's make sure we have a good understanding of what we're talking about here. Describe the systematic and non-systematic risk of these two assets, a 3-month T-bill. What is the systematic and non-systematic risk? Well, a 3-month T-bill, what is that really? Well, that's a risk-free asset. It's sold at a discount, matures at par. What is the variance of a risk-free asset? 0. So what type of systematic risk does it have? None. What type of non-systematic risk does it have? None. So it would have none. Number 2, the S&P 500 with a variance of 20%. What type of risk does that have? Well, we know that the market portfolio has market risk. So if we want to determine what the level of market risk is, we can simply look at the S&P 500 and look at the variance of the returns over time, whether we're looking at it daily, weekly, monthly. But we can do that statistically. We know how to do that. There would be no non-systematic risk because the market portfolio is a well-diversified portfolio with 500 constituents that make up the portfolio, not just 15 or 20 or 50, but 500. We can safely say that all non-systematic risk has been diversified. All that's left is systematic risk. Second point here, let's say we have two assets. Asset A, total risk 30%, total variance 30%, and B, total variance 17%. But for asset A, we'll get to how we get to these conclusions. Let's just say that we know this for now. Has variance 15% systematic and 15% non-systematic. And asset B has all of it is systematic risk. None of it is non-systematic risk. So A clearly is riskier, variance of 30%. B is 17%. The question is, which asset should have the higher expected return? Now, somebody who doesn't understand that you should not get paid for non-systematic risk would say asset A. Higher risk, higher return. It should have the higher expected return. But hold on now. We can diversify away 15% of it. So we should not get paid for what we can diversify away. The market will make sure of that because people will step in, and all you need are big players to step in and say, you know what, I get it. Let me step in and buy these things, and I'll get that 15% for free. Well, eventually that 15% would disappear. So we should only get paid for the 15% systematic risk. Asset B has 17% systematic risk. So asset B would have the higher expected return because here we're assuming 17% systematic risk as opposed to just 15%. That is a typical question you would see on a CFA exam, by the way. That is a very typical question you would see on there. There might be 3 assets because you need 3 A, B, and C, right? Might be 3 assets that list it and break it down. You're looking for the one with the highest systematic risk. You don't get paid for non-systematic risk. Capital market theory states that very specifically. The market will expect a higher return on the investment that has a higher level of systematic risk regardless of the total risk. That's a hard pill to swallow. There's a lot of students that say, wait a minute here, I don't think that makes a lot of sense. I don't think that makes a lot of sense at all. Well, it does. It actually does make a lot of sense. Non-systematic risk is not rewarded by an efficient market. So, if you're one of those people who say that doesn't make a lot of sense, you're probably also one of those people who would say the market is not efficient. And if the market is not efficient, then you got a point there. But if you think the market is efficient, remember we've already been through market efficiency. If you think the market is efficient, then no, you are not going to get paid for non-systematic risk. The market will only reward systematic risk. So we are now on LOSD. Keyword here is to explain. Explain return generating models. Return generating models, including the market model and their uses. So let's set the stage. It's easier if we just make 3 nice points and then sort of give ourselves a problem that we would have. And the answer to our problem is a return generating model. How about we do it that way? So what do we know? Number 1, non-systematic risk can be avoided. We know that. And is therefore not rewarded. You can agree or disagree with that, but that's the conclusion that we've gotten to. Non-systematic risk can be avoided and is therefore not rewarded. Number 2, securities are priced to reward systematic risk only. Number 3, securities with more systematic risk should offer a higher return. Fabulous. There's the 3 points that we've made in our last learning objective. So let's say that we were going to construct an optimal portfolio, which is the market portfolio. And we know the market portfolio is all available assets that are investable and tradable. But at the time that we introduced the concept of a market portfolio, we said, yeah, but that's a lot of work. Let's just pick an equity index. You pick the S&P 500. It's got 500 components. Okay. The Russell 1000 has 1,000 components. Well, if you use the Russell 1000 as an example, I just want to show you how ridiculous this gets. If you were going to use that as your market portfolio, you need to calculate 2 things to determine your optimal portfolio. You need to determine the return on the portfolio and the variance of the portfolio. So, how would you calculate the return? Well, you have 1,000 components. You're going to need 1,000 return estimates, along with all the weightings on those return estimates. And there you go. And maybe you have a nice spreadsheet and that can figure it out for you. But how do you calculate the variance of the portfolio? Well, you need all the weightings, which we already have, but you're going to need 1,000 standard deviations to get it done. You'll have 1,000 individual variance components making up the variance of the portfolio, plus all the covariance terms. Well, how many covariance terms do we need? 500,000. 499,500 correlations. That's just ridiculous. There's got to be a better way. There simply has to be a better way. And it turns out there is. Now this is if we didn't understand the idea of systematic and non-systematic risk and we just thought that, you know what, we get compensated for total risk. The total variance is what we need to find, and that's what's going to set our expected return. This is saying, no. You just need to find a way to capture the systematic risk and ignore the rest. Well, once we do that, how do we determine what the expected return is if we're not using the total variance anymore? If now it's a function of a different type of risk, not all the risk of the asset, but some of it. So the first question is, well, how much is some of it? And then once we know how much is some of it, how do we figure out what our return is? Well, to do that, we need a return generating model. So the alternative to calculating all of those standard deviations and all of those covariances is we will begin with a known portfolio, such as the equity index, like the S&P 500. Let's begin with that. With the S&P 500, we can measure the expected return on the market and the variance on the market using historical data. We can use historical returns for the S&P 500. And from that, we can measure the variability in those returns. We'll get a measure for variance. That becomes our benchmark for systematic risk. Why? Because we're starting with a known market portfolio and we're measuring the variance on that portfolio. Aha! Now we have a benchmark for systematic risk. Beautiful. Then we compare a securities historic when we don't have the E in front. E means expected. When we drop the E, that means we're looking at historical. We're looking at actual data. We're going to compare a securities return to the return on the market using linear regression. What's that going to give us? That's going to give us a measure. Since here's the thing now. Since we're already saying, look, you're not going to get compensated for non-systematic risk, which means the price is only capturing systematic risk. How much systematic risk does it have? We'll do a regression of the return on any particular asset and the return on the market, and we'll get some measure of how this varies with this, right? So what we're looking for here is the covariance between the two divided by the divided by the variance of the market portfolio. This gives us an estimate of the security's systematic risk. So we're just going to get the covariance between them, and we can do that. That is simple enough. That's just one asset, and the market portfolio is one asset. So we have one covariance divided, of course, by, and we can always find the variance on the market portfolio. We're just using historical data. We can always find that. And there's our estimate of the security's systematic risk. So if we only get rewarded based on systematic risk, which we can find the security's systematic risk, if we only get rewarded based on that, we need some way of determining what the expected return should now be. We can't use the traditional method for expected return because that required us to say, well, how many assets do we have? How are we weighting them in this portfolio? And off we go. Well, we don't have that. We just want to know what the expected return should be based on this measure of systematic risk. So now we can get a little more formal about what a return generating model is. It is a model that can provide an estimate of the expected return of any particular asset. And we'll start with a multi-factor model. And a multi-factor model considers many factors in arriving at an estimate for what an expected return would be. So what we would do with a multi-factor model is we would look at all the returns in the past and find some major factors that correlate well with those returns and use those as the explanatory tool for what the return would be, project out what we think those variables will be, and come up with an expected return. We can use macroeconomic factors like growth, interest rates, and so on, fundamental factors, earnings, cash flow, book value, things like that, or statistical factors. Perhaps there's a time series or cross-sectional data that we can use. And we can develop a model which gives us our excess return. This is the expected return on this particular asset minus the risk-free rate should equal, and all of this are all of our factors. And the beta is the weighting on that factor. So from j equals 1 to k, we're saying we have k factors, however many factors you want. And beta ij is the factor weights. F stands for factor. So there's factor 1, factor 2, factor 3, all the way to k factors. And bi is this particular asset, and j is the beta 1 would be the weighting on the first factor, beta 2 would be the loading on the second factor, etc. Well, we can break this out into one other step. We're going to take one factor out that we know we're going to keep. We're going to take one factor out right away, which is the market return. So we're saying right away, hey, listen, whatever multi-factor model you're going to use, you're going to put the market return in as one explanatory mechanism. Why? Because there's your systematic risk. So if you're looking at the excess return for this asset over the risk-free rate, some of that excess return is derived from the market. So let's stick that in, and then you can have all your other factors over here. So our first factor is the excess market return, the expected return on the market minus the risk-free rate. And of course, it has its own loading, its own coefficient, its beta coefficient. Plus, now look at this, j equals 2 to k, so j onwards. Now, here's the reason why we want this one in here specifically, and we don't really care what factors are in here. Now, I'm going to give you the explanation without it and with it. If you do a regression, and let's say that you identify 3 factors you want in that regression model. Those factors will attempt to explain as much of the variance as it can. It will extract as much variance, each factor will extract as much variance as possible. But here's the deal. Let's say that there was one factor you left out, but that one factor is a critical factor, but you left it out. Suddenly, if you leave it out, it's called an omitted variable. If you leave it out, the three that you did use will suddenly look significant, or may look significant in the absence of that omitted factor, because it's not there to capture most of that variance. But if you put it in, so if you run a regression, let's say with three factors here, those three factors might be significant. The beta coefficients might be significant on them. But as soon as you introduce the market term in here, what happens in a regression is this will take a lot of the variance out for itself, because chances are it matters, but it may not leave enough for the factors to be significant anymore. In other words, their significance may drop out. In a regression, the inclusion of that term will absorb variance from the other factors. And here's the deal. Financial research finds little evidence that the second term, this all over here, finds little evidence that the second term is very useful. In fact, if you start with a multi-factor model and you use one of your factors being the market model, whatever other factors you add end up explaining very little of the variance. The first factor has been found to explain almost up to 75% of the variance, not of the return, of the variance of the particular asset that you're measuring. 75% of the variance in the returns. Well, that's huge. You don't need these other factors. So, what have we done? Well, we started with a multi-factor model. That had a bunch of factors in there, but we said, listen, let's put one in there for sure. Let's put the excess return on the market in there. And we found that if we put the excess market return in there, previous financial research says, you know what, if you put that in as a factor, in any multi-factor model, those other factors, they're not that important anymore. So the natural conclusion would be, well, let's keep things simple and parsimonious. Let's drop those other factors and let's just work with that single factor. And that's what we get to, a single index model, a single factor linear model where the only factor we're using is the excess return on the market. And of course, the beta is the coefficient on that particular factor. So we write the same thing out again, the expected return on the particular asset we're looking at minus the risk-free rate, that's our excess return on the security, is some linear combination of beta and the excess return on the market. The second term is dropped out. All right, let's just leave this right now. Let's just draw a line under there, nice little line. Let me approach this from underneath. So come all the way over here and let's just put a placeholder there. Follow me on this. You'll recall what this is. This, of course, is our capital market line. M is our market portfolio, and the capital market line is just tangent to the market portfolio. And the function of this line, the way we can write it out, is our expected return on the portfolio is some function of the risk that we take on. And we write it out this way. Well, it has an intercept, the risk-free rate, because if the portfolio variance is 0, we'll get the risk-free rate, plus the slope of the line times the variance of the portfolio. But on this capital market line, we should be able to price any combination of the risk-free asset and the market portfolio. When we combine the risk-free asset and the market portfolio, we're really creating a new portfolio, a new asset. So we can put it here and we can use the capital market line to price it out because we know the slope. We know the slope of the line. So if we know how much risk we're taking on, we know how much above the risk-free rate our return is. If we're here, we can do the same thing. How much risk do we have? I can figure this out. The capital market line helps us price any asset anywhere on the line we are. So let's say we want to price out some combination. Let's just call it the expected return for RI. So we can use and we don't have to calculate for the whole portfolio. We can call it just asset I. So the expected return on I, and what we're going to do is take this risk-free rate, bring it over to the other side. It's a positive here, so it'll be minus. The expected return on the asset minus the risk-free rate equals, let's just do some rearranging here. This is the excess return.
divided by the standard deviation of the market times the standard deviation of the portfolio. Well, if we're going to use some generic asset, we'll call this the standard deviation of that generic asset. This term here is really just this term here, just written out differently. You'll see that if you multiply this out and you bring the two terms over, you'll get the same thing. I've just rearranged everything because we all know that x times y times z is the same as z times y times x, so it doesn't matter which way you place it. We'll look up here. Let's now reapproach this from the top. If our single index model looks like this is the excess return on the particular asset we're looking at. There it is right there. Equals some coefficient times the excess return on the market. There's the excess return on the market. So this ratio must be this coefficient, so that we can use the capital market line. In a single index model, we can use the capital market line to price out any asset. What is this ratio telling us? In words, the numerator is the total security risk. That's the standard deviation over. That's the total security risk. The denominator is the total market risk. So we have a ratio of total security risk to total market risk. Let's decompose that, especially the numerator, into the systematic and non-systematic risk and see if we can't isolate what we're looking for. So this is where we left off on our last screen, total security risk over total market risk, but we can decompose our total security risk. So we can rewrite it out like this. Total market risk is what? It's systematic risk. And our numerator, it contains what? If it's total security risk, it contains a systematic component and a non-systematic component. We know that. But we've already learned that we are not rewarded for this. So let's just make a note of that. We're not rewarded for this. So we can ignore that. We can just say, you know what, we're going to ignore that. What do we have left? We have the security systematic risk divided by the market's systematic risk. Well, what is market systematic risk? There it is right there. What is the security systematic risk? Look what I'm doing in the numerator here. I'm expressing the security systematic risk as some function, as some coefficient on the market systematic risk. So it is some multiple of the market risk. So if the security systematic risk is identical to the market systematic risk, our beta coefficient would be 1. If it's twice as much, it would be 2. So beta captures how much riskier or less risky this security is in terms of its systematic risk with the systematic risk of the market. And we end up with a measure called beta. Now, we can take this term now and say, instead of having this term in here, remember now, we derived all of this from the capital market line. We're going to take this out and we're going to resubstitute beta in, so this is what we get. We still get the expected return on the asset we're looking at minus the risk-free rate equals beta times the excess market return. Well, let's return the risk-free rate to its proper side. And what we'll get is the expected return on whatever asset we're looking at is the risk-free rate plus some beta multiple of the excess market return. There's our cap M. So the return generating model that we're going to use, and here's the return. This is what we want to generate. What is the expected return on this particular asset? Well, that's easy enough. All I need is the risk-free rate. I need the equity risk premium, the return on the expected return on the market minus the risk-free rate, and I need some measure of beta. Well, I can get that measure of beta. That's easy enough for me to get. We'll describe how that is done as we continue on, but I need that measure of beta. So let's just expand this term in here. Notice this is beta inside the brackets. We have these two terms. Well, let's just expand it. So that'll give us the risk-free rate plus beta times the expected return on the market minus beta times the risk-free rate. Bring this over to this side so the two risk-free rates are together. We'll have the risk-free rate minus beta times the risk-free rate plus beta times the expected return on the market. This is just algebra right now. Well, there's a common term here, which is the risk-free rate. So let's take it out. The risk-free rate, 1 minus beta, plus beta times the expected return on the market. Now, let's move from expectations to actual values so that we can drop this E out. We're going to move from expectations to actual values. So let's take the expectation out and let's just keep the actual value. The returns that we've seen on this particular index, remember now we're using historical values, we're using actual values, we can look at all the returns on this particular asset. Should equal alpha. What is alpha? Alpha is all of this now. This is our alpha term. This is written as alpha plus beta something, right? Equals alpha plus beta, there's all the returns on the market, plus some error term. That's all that is. This is just a basic form of regression. Y equals A plus BX plus some error term. This is called the market model. Now, alpha and beta can now be estimated using historical security market returns. So all I need, if I want to know what my beta is, let's say I'm interested in the last 2 years of returns on a particular stock versus the market, I can look at daily returns on a particular stock and daily returns on the market as a whole. And then I can run a regression and find out what my alpha and what my beta coefficients are. And anything that's not captured by that will show up in the error term. Now, this will give me all of my systematic risk. This will tell me what my non-systematic risk is. So let's see how that's solved in a particular problem, or let's see how it's applied. And I think you'll say, okay, now I get it. Let's take Walmart versus the S&P 500, and let's look at some daily returns. And what we've done is we've taken maybe a year, 2 years of Walmart daily returns and S&P 500 daily returns, ran a regression, and the SPSS spit out an alpha of 0.0001 or a beta of 0.9. For those that don't have access to SPSS, you can easily run this in Excel as well. Alpha is 0.0001 and beta is 0.9. So on a given day, this is so we can rewrite our equation, our market model equation. The return on Walmart is equal to our alpha, 0.0001, plus our beta times the market return, 0.9, plus some error term for Walmart. So on a given day, if the return on the market was 1% and the return on Walmart was 2%, find the return on Walmart due to non-systematic risk only. In other words, of that 2%, how much was due to non-systematic risk? How much was due to systematic risk? Well, we can capture non-systematic risk in the error term. So that's all we need to do is capture it in the error term. So we can just plug in what we know for all of these things and solve for E. The return on Walmart was 0.02. And of course, we'll have to subtract all of this term in here, and we'll be subtracting alpha minus beta return on the market, right? Which is minus 0.0001 plus 0.9 times 0.01. 0.9 is our beta. We've already calculated that. 0.001 is our alpha. And the 0.1 in here is the return on the market for that day. And the return on the market, we're told, was 1%. So it'll be 0.02 minus this term, which will give us 0.0109 or 1.09%. 1.09%. That is company-specific return. That is the return that we can say Walmart was able to generate 1.09% return today. The market helped it out. But on its own, Walmart was able to do better. So we were able to capture the systematic risk in Walmart. The error term in the market model captures the non-systematic risk. Everything here, alpha and beta, are done using historical returns and a statistical package to help us determine what the alpha and beta coefficients are when we have our data series for the returns on I and the returns on the market. Simple regression, a linear regression, will give us this term. This is actually, if you've ever taken an econometrics course, this will be the first model that you come across. This will be the very first model, a simple one variable linear regression. Simple.
Well, we're starting our next learning objective, LOSE, calculate and interpret beta. So to get there, let's just do a one-screen review and a one-screen preview, and we'll jump right into beta. I'll make this quick. We have seen so far that if we take two risky assets that are not perfectly correlated and combine them together, we can actually achieve the same or higher return for the same or lower risk. That's the power of diversification. So if we continue that process, if we take a whole bunch of securities and begin to combine them, we find that we can start to reduce our risk up to a point. After that, our return will increase, but our risk will also start to increase as well. That point, we said, is the global minimum variance portfolio. And as we move up the efficient frontier, every portfolio on here will have different weightings of the securities in to reach for more return, but we will be taking on more risk until at the end, in the extreme, 100% of our money will be in only the security that offers the highest expected return. Period. So if we want to know where the end of this efficient frontier is, out of the universe of assets, just say which one offers the highest expected return. There's one anchor point on this efficient frontier. Then you just find the point that offers the minimum variance, and that would be there. And of course, you have your efficient frontier. We also saw that, well, now if you combine that with a risk-free asset, from the risk-free asset to the tangent on this line, you would have a linear combination of the risk-free asset and the portfolio identified by this point. We call that the market portfolio. We'll be more clear in a second what we mean by that. When that is the market portfolio, the line then becomes what's called the capital market line. So that any point below the market line is inefficient because we can move up to the market line. The implication is that every investor should hold some combination of the market portfolio and the risk-free asset. Let's say that you want it to be 100% in security I. It would be inefficient because you could argue that, well, why don't you just move up to the capital market line, hold a well-diversified market portfolio, borrow at the risk-free rate, and leverage the market portfolio. You'll get a higher return for the same level of risk. Every rational investor would say, yeah, you're right. There's no point in me holding a big concentrated position here when I can achieve the same thing by leveraging a market portfolio. Thank you for that. Great. Well, the real body of this work was developed by Markowitz. And to follow through with this, here's what we need. We require the entire security universe. To develop this market portfolio, you require the security. This is all investable and tradable securities. And we know that that's just, well, that would be ridiculous to do. So we say that the market portfolio is, pick any broad equity index. Well, let's say the S&P 500. So this becomes the capital market line if the tangent point on here is the market portfolio, and as far as Markowitz is concerned, it is the market portfolio only if it includes all possible investments. All possible investments. We can see how daunting a task that would be. But again, we're dealing in the realm of theory. We're going to start walking more towards a practical approach shortly. This is the realm of theory. So in this market portfolio, what are the weightings of the individual securities in this market portfolio? The weightings on any one particular asset in here will be the market value of that asset divided by the sum of all market values. And that's it. What's the other thing that Markowitz says we need? We need the entire security universe, and we need the covariance matrix between all possible combinations. Well, we saw earlier that that is a huge problem. If we're going to move from 100% in this security with the highest return towards the market portfolio, we're going to be increasing the number of securities we start to include in there. So we can reduce our variance. Notice here's our variance on the portfolio. We can reduce the variance the greater the number of securities in the portfolio. But the greater the number of securities, the more troublesome and huge and difficult to work with this covariance matrix becomes, right? So before I go, I just want to point out one more thing. We've pretty much, I've brought you up to speed to the end of Markowitz, but I just want to point out one more thing before we move forward. This risk-free rate over here is a constant. Let's be sure that we understand that that is a constant. It never changes. So what is the constant? What is the covariance between the market rate of return and a constant? Well, the constant never changes, right? Therefore, our covariance between the RF and RM will be 0. Just so that we've mentioned that before, I just wanted to point it out on here again. So there's our problem right there. There's our problem. So given that problem with the covariance, in the last learning objective, we introduced the concept of beta. We're saying rather than deal with that covariance matrix, let's take the market portfolio as given. Let's measure the variance of that market portfolio, and that variance we'll call the market risk or systematic risk. And then we'll just compare every individual security's systematic risk against the market. Now we don't need that variance, covariance matrix with all those entries. We need one measure for each security, beta. So let's just replace the horizontal on our graph and take out the variance of the portfolio and replace it with beta. The market beta is 1. The risk-free asset has a beta of 0, and we still have our same, our capital market line. But now that we're dealing in betas, this is now called a security market line. Well, what's the difference other than the fact that, okay, does the security market line deal with just beta and the capital market line? If I see a variance on the horizontal, I call it a capital market line. Well, yes, but it has a slightly different interpretation. The capital market line, the slope of that capital market line, remember, was the market price of risk, allowed us to price out what the expected return would be given a level of risk for any well-diversified portfolio that we can choose. For any well-diversified portfolio that we can choose. This is not a capital market line, this is a security market line, which allows us to find an expected return for any one particular security. The capital allocation line prices out the expected return based on the risk we're taking for any well-diversified portfolio. Here we can take any one particular security and price it out along that line. So it is still the market price of risk, but rather than dealing with a well-diversified portfolio, we can do it security by security now. That's nice. So the market portfolio we know has a beta of 1. This is its XY coordinate. It has a beta of 1, expected return on the market, ERM. The beta of the portfolio is nothing more than a weighted average of the individual securities beta, so that we can see that the average beta of all the stocks in the market must be 1 because the market beta is 1. Given the security market line and given any beta, any securities beta, plus the return on the market, we can estimate what the expected return on the security would be. Remember, we went through a whole learning objective on return generating models. Here's our return generating model. All we need now is beta. We don't have to worry about all of those variances and covariances. Now, before we head into the calculation of beta directly, we have an anchor point of the risk-free rate, and we have our market portfolio with a certain level of variance attached to it. Both of them change as economic conditions change. Both of them can change. The risk-free rate doesn't have to stay here. It's not a constant. It might be a 30-day constant, but it's certainly not a 2-year constant. It can fluctuate, and the volatility of the market can also fluctuate as well, which means the slope of the security market line can also change. The slope of the security market line can steepen or flatten, which means the market price of risk can either steepen or flatten, so that the value, the expected return on individual securities can change depending on how conditions in the market change, which I think is a fairly straightforward statement, right? So let's see how we would calculate beta. You'll recall the market model that we left off with earlier. The return on any particular security equals alpha plus beta. This is just a factor loading on the market return. Beta I
Rm plus the error term, epsilon I. And the error term has an expected value of 0, but still has a variance greater than 0. So its expected return is 0, or the expected value of the error term is 0, not its expected return. And the variance is still greater than 0. So what this is saying here is that this captures the idiosyncratic risk, or the non-systematic risk of the security, and the non-systematic risk will still be there. However, it's not going to be rewarded. We already know that. So what we're going to do is we had put in alpha to stand in for 1 minus beta times the risk-free rate. In getting to the market model, one of the steps along the way ended here, and I said, let's just take all of this, since this is a constant, and we'll just make it alpha, because that's a constant, right? So we'll just put it back in right now. So that is how we would get to the return on a particular asset. How do we capture the systematic risk associated with that return? Well, we can use the covariance between the return on that particular asset versus the return on the market. So we can just try to, we need a measure of the covariance between these two terms. So let's use some algebra and figure out where we can go and collect terms and simplify, because sometimes we can get to a better result with math, right? So the covariance between Ri and Rm, well, what is Ri? Ri is all of this. Ri is all of this. But the first term is a constant. So what is the covariance of the first term with the return on the market going to be? It's a constant. It's going to be 0. That component of the total, since it's a constant, is going to be 0, because no matter what this fluctuates to, it'll always be added to a constant. We only want the part that fluctuates, so we can get rid of the constant. So we could just drop that out. This is the only term that we want. So we're looking for the covariance between the return on I, and the return on I is beta I times Rm plus epsilon I, and the return on the market. That's the covariance we're looking for. All I did was expand Ri. Well, we have a plus sign in here. When we have a plus sign, we can actually separate it. So we're actually looking for the covariance between beta I Rm and Rm plus the covariance between epsilon I and Rm. Well, we have beta Rm in here. We can bring beta to the outside. Equals beta I times the covariance of Rm plus the covariance of epsilon I Rm. Great. Isn't math wonderful what it can do for us? What do we have in here? Rm, the covariance between a return and itself. This is just a variance. So our first term simplifies to a variance, the variance on the market. Plus, we have the covariance between two terms. Well, what are they measuring? We know that this is measuring, Rm is measuring systematic risk. We're going to get some systematic risk out of this. What's the first term going to capture? The first term captures non-systematic risk. Well, the non-systematic risk is uncorrelated with the systematic risk. So if these two are uncorrelated, its covariance must be 0. So what are we left with? We're left with a statement that says the covariance of Ri Rm is equal to beta I times the variance on the market. We're going to rearrange some terms in here, so let's give ourselves some more room. And we're going to isolate beta to one side, because that's what we want to calculate. We want to solve, how do we find out what beta is for any particular security? Well, it appears to equal the covariance between Ri and Rm divided by the variance of the market. All I did was isolate beta and rearrange it. So we've gone from something like this to something like this. Nice and simple, right? Well, what can we do? Can we simplify even more? Well, we know that the covariance of something is the correlation between the two times the standard deviation of each one. And for the denominator, since it's a square, we can separate it out into the multiplication of two standard deviations. These two terms cancel. What are we left with? We're left with the correlation times the standard deviation of I over the standard deviation of M. And you will recall when we did the factor loading in the single index model on the last learning objective, when we did return generating models,
we got to a factor loading on the excess return on the market of the standard deviation of I over the standard deviation of M, and we said that this was the systematic and the non-systematic risk divided by just the systematic risk. Well, there it is right there. We have the same term, except to turn this into a measure of beta, we multiply that factor loading by the correlation between the two. That's all. So that's a long road to get to that statement. We already had this. We already had this factor loading, and I had to bring you through that long process to get you to the correlation that all you do is you just adjust this factor loading by the correlation between the two. You've got beta. So here's our market model again. There's our beta, and it contains, we know now, it contains an adjustment for the correlation. So it was, of course, the standard deviation of the asset we're looking at divided by the standard deviation of the market adjusted for the correlation. That's beta. And beta is a measure of how sensitive an asset's return is to the market as a whole. It captures an asset's systematic risk. There we go. What a beautiful thing. We don't need that big covariance matrix anymore. We just need beta. And it looks like we can get beta quite easily. We only need 3 variables to solve for beta. If we're looking at the beta of the market, just to show you how well that particular function works that we just derived, remember it's the correlation of the two assets times the standard deviation of the first over the standard deviation of the second. Well, if we're looking for the beta of the market, we're looking for the standard deviation of the market divided by the standard deviation of the market, and the correlation between the two will equal 1. Therefore, the average beta of stocks in the market must also be 1. Most have a correlation. Most stocks have a correlation with the market of about 0.7 or higher. About 0.7 or higher. So let's see if we can use this to figure a few things out. Let's say that the standard deviation of the market is 25%. That's all we really need to know. Find beta on number 1 on a 30-day T-bill. Well, we know that the 30-day T-bill is a constant. So it's going to have no variability with the market whatsoever. So beta is nice and easy in this case. It's 0. Number 2, find beta for gold. It has a standard deviation of 25% and a correlation with the market of 0%. Well, if it has a correlation of 0, the numerator up here would be 0. It is also 0. It looks like I've chosen some pretty easy problems, right? What about this particular security here? We have a security with a standard deviation of 60% and a negative correlation with the market of 0.1. A negative correlation of 0.1. How do we solve that one? We would have negative 0.1 times 0.6 divided by 0.25 will give us negative 0.24. So it would have a beta. This stock would have a beta of negative 0.24. So now we can easily figure out the return or the expected return on this particular security by multiplying its beta by the expected return on the market. We have another asset here, 40%. This one has a correlation of 0.7. What's its beta? Well, it's the correlation times the individual standard deviation on the security divided by the market standard deviation, which we know is 0.25, will give us 1.12. Now we can go directly and solve for the expected return of this particular security given the return on the market and that particular beta. So we can calculate a beta if we have, number 1, an estimate of the standard deviation of the security we're interested in. Number 2, an estimate of the standard deviation on the market. And number 3, a value for the correlation between the two. So we only need 3 variables now to calculate the expected return on any particular asset. We need these 3 to calculate beta. Beta in combination with the security market line will help us calculate the expected return. But that's still a lot of work. So a more practical way to do it is let's just calculate beta directly. This is calculating it indirectly. We have a number of statistics that we're going to derive, and then we can calculate beta. Well, let's just do it directly using the market model. This was the market model here. This is a regression formula with just one variable. We have a dependent variable, RI, and we have an independent variable, the return on the market. So the return on this particular security is some function of the return on the market. The coefficient of that is our estimate of beta. And we just use regression to do it. So let's say that we plot the return on the market here and the return on the particular security, and we notice we plot a whole bunch of points over time, whether these are daily returns or weekly returns or over 1 year, 2 years, whatever. You plot them out, and there'll be a line of best fit. It's called the least squares line because it minimizes the squared deviations from the line. And that is a line of regression. It'll give you some intercept alpha and some coefficient on the return on the market. That's beta. There it is. That's beta. That's as easy as we can calculate beta. Look, you're going to have to use some statistical analysis to get a standard deviation on the returns on I, and some to get the standard deviation of the returns on M. Why not just put them together in one regression, and what gets spit out? Beta will just get spit out automatically. You won't have to take these two and then calculate beta. Beta will just happen. So that's the more common way of estimating beta, is with a regression analysis. The only question you have left is over what time frame. Do we take daily returns over the last year, the last 2 years, the last 3, the last 5? The shorter the period, typically the better. But too short might capture too much idiosyncratic risk with a particular asset, especially if a company has had some significant movements in the last year. So you have to look at the security and say, well, what is a more realistic range? And you got to be careful, especially with growing companies. You take a beta over the last 2 years of a company that was, let's say, a small cap and now it's a mid cap, and you want to use that beta going forward, and it's inevitable that that company is going to be a large cap stock. That beta may not. That beta may be too high to reflect a movement going forward. You may have to adjust the beta down. So the betas are historical. You're free to adjust them if you think the future will be different than the past. But it's a nice direct way to get them using a regression analysis, and you're done. So if we look at the expected return on our particular asset, we can recall using CAPM that it equaled the risk-free rate plus beta times the equity risk premium. There's our beta. That's how we get beta into CAPM, is we do a regression on that particular asset we're interested in with the market, and we regress the returns on each other. RM is our independent variable, RI is our dependent variable, and we just stick beta in there. So let's look at a few problems before we go away, because in looking at these problems, it's going to bring up an interesting question, and we'll see if we can't get that out of the way. I'm sure some of you already have this question in your mind, even though I'm not going to tell you what the question is yet. Let's look at a company that has decided to buy another company, and in buying that other company, some of its statistics have changed. So before it bought the other company, it had a standard deviation of returns of 0.5 and a correlation with the market of 0.95. After it bought the company, it clearly diversified. It lowered its risk, so it had a standard deviation of returns of 0.3, and it also lowered its correlation with the market to 0.75. So let's calculate a beta before and after this event. So the beta before, this is very straightforward. It's the correlation between itself and the market times its own standard deviation divided by the standard deviation of the market. All the market statistics are right here. And that will give us a beta of 1.90. So we can use the CAPM to figure out the expected return on this particular asset. It is the risk-free rate plus its beta times the equity risk premium, which is 0.1 on the market minus 0.03 on the risk-free rate for 16.3%. After the fact, we have a beta of 0.075 and a lower risk factor on the security divided by 0.25. We should get a much lower beta, and we do, 0.90. Now watch this. This should give you some cause for concern, and I will try to alleviate that concern. What is the expected return on this security now? Well, it is the risk-free rate, 0.03, times the beta, 0.9, times the equity risk premium. And if you solve for that, you'll get 9.3%. Now, you may be saying, wait a minute here. You're telling me that this company went out, bought another company, it lowered the company's risk, which means it must have been very good for diversification, lowered its correlation to the market, and suddenly it's got a lower expected return than when it didn't have the other company? shouldn't it earn more? Shouldn't we think that this stock is going to do even better now that it's diversified some of its risk away? Shouldn't it be a better company? I thought when we did a present value of all the future cash flows and we discounted those cash flows, we discounted them for some risk, for some required rate of return. Wouldn't that required rate of return be lower? Wouldn't those cash flows be worth more? And you're telling me that it's worth less? Now, let's go a little bit further. Let's say this company keeps diversifying and eventually it has no correlation with the market. This would tell you that the expected return would be the risk-free rate. Everything here would disappear and the expected return would be the risk-free rate. At that point, you'd be saying, well, okay, stop. How can that be possible? If the expected return on this company were the risk-free rate, no one would buy it. They would just buy the risk-free asset. Because a beta of 0 does not imply that it has no variance. It would still have variance, so that the risk-free asset would still provide a better place to be because it would provide the same expected return, 3%, with 0 variance. So isn't there something fundamentally wrong with beta? That as beta tends towards 0, that doesn't mean that the risk tends towards 0. It just means that the systematic risk is uncorrelated with the market. Suddenly the asset only returns its risk-free rate. Well, now, here's the missing link in that. That's a very popular statement, and when I was first learning this years ago, I had trouble with that, saying it makes no sense that a company that improves its position in the market, decreases the risks of its cash flow, suddenly has an expected return close to the risk-free rate. That makes no sense at all. Well, think about it this way. The expected return is made up of two components. It's made up of the dividends you receive plus any price appreciation. If the company is doing these things to lower the risk of its future cash flows, the price in the marketplace will be bid up. It will be bid up, thereby making the return component, remember it's made up of two things, capital appreciation plus the dividends. If it's being bid up in the market, suddenly if you start to buy it at that higher price, there's less chance of a capital gain. Remember, the market is informationally efficient. The price will reflect that information very quickly and there'll be no excess return available other than the required rate of return. But if you're lowering the risk of those cash flows, the required rate of return will be lower, hence giving you exactly what that is. So when we think about betas dropping all the way to 0 and then providing only the risk-free rate, if betas are dropping to 0, the systematic risk, its correlation with the systematic risk is also dropping as well. So you have to keep that in mind, that the market, if that's going on, something occurred to make that happen. Some information occurred, and since the market is informationally efficient, it will be reflected in price. The change in price from the time you buy to over your holding period is one of the components of expected return. Example number 2, risk-free rate is 3%. Return on the market is 10. Company has a beta of 1.5. What's its expected return? Simple enough on this one. 0.03 plus 1.5 times the equity premium is 0.1 minus 0.03 will give us 13.5%. Let's say an analyst comes along and says, yeah, well, that was its historical beta, but this is a growing company. Given the size that the company is at now, it's going to move more in lockstep with the market. It's going to act more like the market because it's so large, it can't escape the market at this point. So it's not going to have a beta of 1.5, it's going to have a beta of 1.1. What's the expected return on the security now? 0.03 plus 1.1 times the premium will be 10.7%. Again, this is what throws students. It's like, well, hang on a second. If we're saying that this is just a bigger, safer company, how come our expected return is dropping on this particular, on this case? Is because your expected return is made up of those two components.
And if the market is realizing that this is a safer company in terms of cash flow and size, it will bid up the price of that asset such that the expected return, the capital gain component of it, will become smaller and smaller. So it is a valid conclusion. Learning objective F. Keyword explain. Explain the capital asset pricing model, including its assumptions, and the security market line. Well, I think we're pretty familiar with the capital asset pricing model. We haven't really looked into its assumptions either here or in the corporate finance playlist. But we did meet CAPM there, probably more than you wanted to. So anyways, let's just jump right into the assumptions because I'm sure we're familiar with the model. Number one, investors are utility maximizing. I don't see that as being controversial. Are risk averse. I would tend to agree with that overall. And rational. Well, the jury is kind of out on this one about rationality. And remember what rationality is. Rationality is consistency. Well, there's a lot of work done in behavioral finance that shows that depending on the context that we're in, our consistency is not that consistent. At level 3, you'll be introduced to behavioral finance in a lot more depth. But for number one, investors are utility maximizing, risk averse. Maybe they're not rational, but for the most part, I think we can side with they're rational enough. Number two, markets are frictionless, no transaction costs, no taxes, plus borrowing and lending at the risk-free rate. Now, this doesn't necessarily have to hold for everybody. I'll tell you something, it certainly doesn't hold for me. I cannot borrow and lend at the risk-free rate. I pay taxes. I have transaction costs. But all it has to do is for some very large institutions, some very large players that represent a large market share of what happens in the marketplace. It has to lean towards being true for them. The borrowing and lending at the risk-free rate, that tends to be true for them. The no transaction costs, no taxes, not necessarily, but in terms of friction and transaction costs, it represents such a small part of their total costs that it's almost true. That's their troubling one, right? Number three, all investors have the same single period investment horizon, and I'll tell you that's the biggest criticism of CAPM, is it is a single period model. So you can think of a situation where I may not make an optimal decision this year. It may look suboptimal, but only because I'm playing the long game as opposed to the short game. So unfortunately with CAPM, if a company decides that it's going to do that, make some suboptimal decisions for a year or two so that it has incredible growth later on, CAPM won't capture that. And the other troubling part of this is that all investors have the same single period investment horizon. That may not be true. So CAPM is a single period investment horizon, which is why we limit it to investors also having the same single period investment horizon. Number four, investors have homogeneous expectations. That's probably not true. If they do, they arrive at the same valuation for any given asset. If they had homogeneous expectations, or if they were just lazy and said, you know what, everyone knows better than me, they'd be passive investors. If you have different expectations in the market, you see opportunities that others don't, there's an opportunity for active management. Number five, all investments are infinitely divisible. Well, I think we can buy that one. That means we can invest as little or as much as an investor wants. With ETFs now, we don't have to worry about being able to buy the index in chunks. You can buy an ETF that tracks an index a share at a time if you want. So I think we can say, yeah, I like that one, or at least I have no problem with that one. Number six, investors are price takers. For the most part, that's true as well. No investor is large enough to influence prices. And investors that are large enough to influence prices are very careful not to influence prices unless that is what they want to do. So let's have a look at the security market line, SML. We're familiar with the capital market line. The capital market line is a capital allocation line, but a very special type of capital allocation line. It connects the risk-free rate with the market portfolio, as you recall. And it is applied only to efficient portfolios. What lies along the capital market line are efficient portfolios only, some combination of the risk-free asset plus some combination of the optimal portfolio. The reason we move over to the use of beta is so that we can extend our analysis now to both individual securities and inefficient portfolios, since beta captures only systematic risk. So we can just capture the systematic risk of a particular asset, a collection of assets, a well-diversified portfolio, and a not so well-diversified portfolio, almost anything. And basically what we do is we plot the market portfolio here. It has a beta of 1 with its required return. And for any asset, we calculate beta based on some regression between the returns on a particular asset and the return on the market. And if we find that we have a beta over here, the security market line implies that it should have a required return here. If we find that the asset or a portfolio has a beta here, the security market line implies that it should have a required return here. So it's easy enough to determine a required return or the expected return on any asset given its systematic risk. That is the security market line. When the horizontal is the standard deviation, in other words, total risk, in other words, we're plotting the expected return against total risk, that's the capital market line. When we substitute that for beta, when it's the expected return versus beta, then we have a security market line. We'll talk about those two more in detail. There's very definite distinctions between the capital market line and the security market line, and we'll see that especially as we go into LOS H, describe and demonstrate applications of CAPM. So let's say that we have a particular portfolio. How do we find the beta of the portfolio? So we have a portfolio of assets and we're trying to find the beta of the portfolio. What we can do is, if we know the betas of all the constituent components within the portfolio, all we have to do is find the weighting of that constituent in the portfolio, and that its beta will contribute to beta portfolio by that weighting. So we can always arrive at a beta for a portfolio with a weighted average of all the components of the portfolio, so that when we're looking at the expected return or trying to calculate the expected return on the portfolio based on its beta, we have it right here. We don't have to worry about running regressions, because if we build a portfolio going forward, we have no historical returns for it. How would we regress the returns on the portfolio against the returns on the market for a brand new portfolio we just built? The components will have historical returns. We can calculate the beta on each of the components. So that's a nice way to calculate the beta on the portfolio, is just the weighted average. So we can go ahead and do an example of what we left off with on the last screen. Let's say we're forming a portfolio with 3 assets. Here's our assets. We're going to put 20% in a 30-day T-bill, yielding 4%, 30% in the S&P 500 with an expected return of 16%, and 50% in a U.S. stock with a beta of 2. What would be the beta of the portfolio? We're just putting these together. We have no historical data to do a regression, so we're going to use the weighted average of each of the independent betas. And since we have 3 betas, we just have to solve for this. So what's the weighting on the first? 0.2. What is the beta of a 30-day T-bill? Well, the risk-free asset has 0 beta. Plus, what's the weighting on the second asset? 0.3. What's the beta of the S&P 500? By definition, the market, beta is 1. Plus, our weighting on the third is 50%. Our beta here is 2. So once you multiply all of these out, we will get 0 plus 0.3 plus 1 equals 1.3. So we've got a beta on the portfolio of 1.3, which allows us to determine for this beta what is the expected return. And we have the capital asset pricing model to help us do that. Beta on the portfolio times the expected return on the market minus the risk-free rate. And we just put in our variables. Equals 0.04 plus our 1.3. Return on the market 0.16 minus 0.04. Equals 0.04 plus 1.3 times 0.12 will give us 19.6%. So we can get to this number by a different way. If we go back to the very first, not this, the beginning of this reading, but part 1, how do we determine the return on a portfolio? It's a weighted average of the returns on the individual securities. So let's prove that the CAPM gets us to where we want to be. What's the expected return on the risk-free rate? 4%. Expected return on the market is 16%. Expected return on our stock is going to be, we can use CAPM to get to this, 0.04 plus our beta of 2 times 0.16 minus 0.04, which will give us 0.28. 0.16 minus 0.04 is 0.12 times 2 is 0.24 plus 0.04 is 0.28, or 28%. So there's the expected return on each of the assets. Now, for our expected return on the portfolio, remember what we did. It's the weighting on the first times the return plus the weighting on the second times the return on the second plus the weighting on the third times the return on the third. Actually, it should say expected return on each one, but you get where I'm going. Weighting on the first asset was 0.2. The return is 0.04. Weighting on the second asset was 0.3. Expected return is 0.16. Weighting on the third asset is 0.5. Expected return is 0.28. If you multiply all of this out and add them together, you will get 19.6%. Let's get those equal signs. 19.6, 19.6. No matter which way you go, you get 19.6. We're on our next learning objective, LOSG. Calculate and interpret the expected return of an asset using CAPM. So why would we want to, let's put that question out first. Why would we want to calculate the expected return? Well, we would want to determine whether or not an asset is fairly valued by determining what its expected return is. From there, we can determine what a fair price for the asset is. So let's have a look at what we have here. We have a stock whose current price is $20.07. Current dividend is $1.22. The growth rate on the dividend is 6.1%. Stock has a beta of 1.15. The 30-day T-bill rate coming in at 2.1%. The equity risk premium in the market, 8.4%. Is this stock a buy, a hold, or a sell? Based on all this information, we have enough information here to determine whether or not we want to buy it with a plus or minus 5% threshold. So let's figure out what the intrinsic value of this stock is. And to figure out the intrinsic value, we've already done it before. Price is dividend at time 1, R minus G. That is the dividend at time period 1 divided by the required rate of return minus the growth rate. Well, we can figure out D1. That's easy enough. We can start with D0, 122. And in 1 year, if it's the growth rate is 6%, it'll be 1.061. There we go. And it's R minus G. We have our G on the bottom, 0.061, but we don't have R. R is our required rate of return. And what does the learning objective want us to do? Calculate and interpret the expected return of an asset using CAPM. So, since we only get paid, since we only get paid for systematic risk, the expected return is the required rate of return. The expected return that we will get using CAPM will be the required rate of return because it just tells us what's required for the systematic risk we're taking on. So you'll recall it is the expected return on I is equal to the risk-free rate plus beta times the expected return on the market minus the risk-free rate. So do we have all that? Risk-free rate, we do. 0.021 plus our beta is 1.15. and our equity risk premium is 8.4. We're not given the return on the market. If we were given the return on the market, we would subtract the risk-free rate to get the equity risk premium. We already have that. If we add the two, we can see that the return on the market is 10.5%, but we're only given the premium. That's all we need. I forgot a 0 in there. 0.84, which will give us 11.76%. So the required rate of return on this asset is 11.6, so we'll put 0.1176 here. And we can solve for the intrinsic value, 1.29442 in the numerator, 0.0566 in the denominator will give us 2287. So our P naught is 2007. We want a plus or minus 5% threshold, so 5% up from that price gives us 2107. 5% down from that price gives us 1907. We've calculated 2287, hence we have a buy at P naught. So we'll buy at 2007 because it exceeds our 5% threshold. So we figured the intrinsic value of the stock is 2287 based on a required rate of return of 11.26, which was calculated based on the information we have. The current price in the market is 2007. That signals a buy. The final learning objective of this very long reading, LOSH, keywords describe, demonstrate. Describe and demonstrate applications of the capital asset pricing model and the security market line. Okay. Number one, estimate an estimate of the expected return of an asset. We did that in LOSG. We used the estimate of the expected return to calculate the intrinsic value of a stock. Here, we're going to calculate the expected return of a value so that we can find the net present value of a series of cash flows. So we have 6 years here, and we have a series of cash flows. And the cash flows are somewhat complicated because they're probabilistic. In year 1, we're going to spend $500 million. In year 2, we're going to spend $200 million. In year 3, there's a 50% chance that our project is going to work out for us. We'll have to spend another 100, but we'll bring in 5, and there's a 50% chance that it's just going to fail. Which means in year 4, we have the 50% chance that the cash flows will continue, but that 50% chance that it fails is still there. Year 5, 50% chance of 400, but also it's failed. It failed way back here, right? And finally, in year 6, if the project did work out, it's still going on, we'll collect our $400 million plus sell the project for $600 million. The required, the return on the market, is running at 12%. The risk-free rate's running at 2%. So we can see the equity risk premium is 10%. And we've calculated project beta at 2.3. If you're unsure how to calculate a project beta, you're going to want to go through the corporate finance readings again, or the videos again. We calculate project beta in there. What is the net present value of this project? Well, to calculate net present value, we know that the first thing we do is we always construct our timeline and place our cash flows on here. So in year 1, what do we know? Well, we know that we're going to spend $500. Now I'm following the convention of placing cash outflows on the bottom of the line, and my cash outflows will be on the top of the line, so I don't have to put negative and positive signs. Anything on the bottom is just an outflow. Year 2, we have an outflow of $200. Year 3, this is where it gets a little bit tricky, right? But let's not forget the basics that we learned. What do we have here? We have to figure out the expected return. If we have a 50% chance of this cash flow and a 50% chance of that cash flow, then to figure out the value at this point in time, it's 50% times this payoff plus 50% times this payoff. Here's a payoff of 400. At 50% is 200, and 50% is 0, so we have a cash flow of possibly 200 inflow. So that would be based on probability. Here it's 0.5 times 4, and 0.5 times 0 would give us another 200. Again, here is another 200. And finally, we have 1,000 on the top, which is in millions, so it's a billion. And 0 on the bottom, that would be an inflow of 500 million. These are all in millions, so I'm just not going to put all the zeros in. So now we have to discount this back to today to figure out the net present value of the project. Well, we need a required rate of return. Well, we got a project beta. We got a market rate of return and a risk-free rate of return. We have everything we need to calculate the project beta. So let's go ahead and do that. our expected return is going to equal our risk-free rate, 0.02, plus our beta, 2.3, multiplied by the return on the market, minus the risk-free rate. There we go. That will give us 25%. So that's our required rate of return. So now we just have to discount these cash flows back to today, the net present value, by 25%. Negative 500 divided by 1.25 plus negative 200, 1.25 squared, plus 200 plus 200, 1.25 to the 4, plus 200, 1.25 to the 5, and finally 500, 1.25 to the 6. So if we do that calculation, I'm going to say, I was going to write out all the other numbers, but I'll save you that. You can do all the calculator work here. Negative 147.07 million. So obviously we would reject that project. To get to this point, we needed a required rate of return. The nice thing about the security market line is that it allows us to price out any asset. It allows us to arrive at the expected return of any asset, whether it be a single asset, a project, or a well-diversified portfolio. The security market line allows us to do that. The capital market line did not allow us to do that. So as long as we're clear about that, it did not. The capital market line was for determining the expected return on well-diversified portfolios only. Let's continue on. The second application of CAPM is portfolio performance evaluation. And CAPM is only on this side, over here. So we're going to compare two performance measures that do not rely on CAPM with two that actually do rely on CAPM, and these are comparable across. So let's start with the Sharpe ratio. We've seen this many times, the return on the portfolio minus the risk-free rate divided by the standard deviation of the portfolio. Notice the numerator here is the denominator. Here is the standard deviation. We're using total risk. In other words, the denominator is systematic plus non-systematic risk. Comparing that to a Trainer ratio, and the Trainer ratio has the same numerator, the excess return generated by the portfolio, but it's adjusting for only systematic risk, just the systematic risk. So these are the same ratios in the numerator, except the denominator here uses total risk, the denominator here uses systematic risk only. We're going to look at an application of this shortly. I'm just introducing the ratios. The Trainer ratio relies on the capital asset pricing model. The Sharpe ratio does not. The Sharpe ratio, in fact, works off of the capital market line. The Trainer ratio works off of the security market line. I'm going to clear that up when we go through the example as well. Also using total risk is another one called M squared, M for Modigliani, grandfather, granddaughter. So they're both named Modigliani. So rather than call it the Modigliani model, they just say, look, that's ridiculous. Let's just call it M squared. It is the excess return on the portfolio adjusted for total risk. The excess return on the portfolio adjusted for total risk minus the return on the market, the excess return on the market. So it uses market. This ratio here is market risk over portfolio risk. Well, what is the numerator? It's systematic risk. What's in the denominator? Systematic and non-systematic risk. Again, total risk. Total risk in the denominator here. Total risk here as well. Versus Jensen's alpha, which is just a rearrangement of the capital asset pricing model. And here we calculate alpha as the actual return that we generate on the portfolio minus everything in here is what should have been returned. If we had done the expected return based on the beta, if we had used the expected return model, CAPM, it would have given us what return we should have generated, and we compare that to our actual return. So this one's nice and simple. If it's 0, it means the portfolio returned exactly what it should have, no excess return. Anything positive means we have excess return. We can interpret it right away. But the Sharpe ratio and the Trainer ratio, if we get a Sharpe ratio of 0.67, did that beat the market or not? Well, we don't know. You have to calculate a Sharpe ratio for the market. And for the trainer ratio, you would have to know what the ratio is for the market as well to be able to interpret that. Jensen's alpha, you can interpret directly. If alpha is greater than 0, you have excess return, period. You don't have to compare it to anything. So let's go ahead and apply this. This will be a bit of an extended example here. But let's say we have 3 managers, X, Y, Z. We have a very large portfolio, and that very large portfolio has dedicated portions of its portfolio to 3 managers and wants to assess the performance of those 3. Manager X had a return of 10%, standard deviation of 20, beta of 1.1, manager Y stats, manager Z stats. The market returned 9% with a standard deviation of 19, and the risk-free rate was 3%. By the way, right around 20%, that is the proper measure of risk on the market as a whole. That's about right. So we're using numbers that are very close to what it would be in reality here. So we're going to calculate Sharpe ratios and trainer ratios. And notice that the numerator on both are the same. We differ in the denominator. For the Sharpe ratio, we're going to use this column in our denominator. For the trainer ratio, we're going to use this column. But the numerator stays the same on both sides. So let's calculate first of all our expected return on these, what we should have gotten. So and we will use CAPM to calculate expected return. It's the risk-free rate plus our beta, which is 1.1, our return on the market minus the risk-free rate, and that will give us 9.6%. So using CAPM for X, given the beta that we have and given the market statistics, should have returned 9.6%. Manager X returned 10%. What do you think about that? You think Manager X is doing okay? That measure would say yes, right? What about Y? 0.03 plus, it has a beta of 0.7. And of course, what's in the bracket stays the same all the way through. The only thing that changes all the way down is beta. This will give us 7.2%. So how did Manager Y do? Should have returned 7.2%, returned 11%. Really, really good. And Z, based on CAPM, should have had a return 0.6, 0.09 minus 0.03 equals 6.6%. Should I return a 6.6%? Did 12%. So it's easy to see that Z really outperformed, Y outperformed, and X kind of outperformed a little bit. They all did better than what the expected return based on CAPM would say. Let's see how we rank them based on Sharpe ratios and trainer ratios. Let's see if we get the same thing. So the Sharpe ratio here is, of course, in our numerator, we have the return on the portfolio, which was 10% for X minus the risk-free rate, over its risk, 0.20, gives us 0.35. Y did 11%, 0.11 minus 0.03, and only took on 10 standard deviations of risk, gave it a Sharpe ratio of 0.08. We would have expected Y to be greater than X. Y would have returned 7.2, was expected to return 7.2, returned 11, whereas X only returned a little bit more. What do you think for Z? 6.6 versus 12. Do you think its Sharpe ratio will be higher? If we just look at return, Z really outperformed in terms of the extra return it generated. But how did it do on a risk-adjusted basis? You can always get more return by taking on more risk, but you might not be getting paid enough to take on that risk, right? What do we get paid to take on risk? 0.12 minus 0.03 over, look at the standard deviation, that's going to hurt, that's a big one, 0.25 equals 0.36. Based on a risk-adjusted basis, total risk-adjusted, now we're adjusting for total risk, Z pretty much returned the same as X on a risk-adjusted basis. It's just Z probably was a cowboy and took on a lot of risk. How'd the market do? Did they beat the market? Market was 0.09 by 0.03 over 0.19 for the market, 0.32. So they all came in better than the market, but our clear winner is Y. Based on total risk. Well, let's see how they did based on just systematic risk, just the systematic risk that they took on. X is, the numerators here will all stay the same, only the denominators change. So you could just look over here for the numerator, 0.1 minus 0.03 over 1.1, has a beta of 1.1, equals 0.064. Y is 0.11 minus 0.03 over its beta, which is 0.7, gives us 0.114. The Trainer ratio is much higher for Y than it is for X. Y was the clear winner here, so look at that. Y looks like it's winning on this side. Z, 0.12 minus 0.03 divided by its beta was 0.6. Gives us 0.15. All of a sudden, Z's the superstar over here. Look at that. How'd the market do? 0.09, 0.09 minus 0.03 over, what's the beta of the market? 1. It's always 1. 0.06. So you'll notice the Sharpe ratio is hard to interpret unless you have the market, the Sharpe ratio for the market, to see how we did. Again, the Trainer ratios as well allows you to rank them, but did you beat the market? Well, you have to calculate it for the market as well. You can't just look at the result and say, aha, I know exactly what that is. You have to compare it to the market. So the clear winner here is Z. Now that is based purely on systematic risk. We can see that the systematic risk of the portfolio was 0.6. The beta measure of 0.6 versus 0.7 for Y versus 1.1 for X. 1.1, which means if the market was up 10%, X, without doing any heavy lifting, should have been up 11% because its beta was 1.1, should have been up 11%. Whereas portfolio Z would have been up 6% off of that 10. So anything above that 6 was work. The first 6 was easy lifting. So Z really did well because Z has a low level of systematic risk. So it managed its risk. It has nice return and a low level of risk. So that's why its Trainer ratio is very high. But it did not measure idiosyncratic risk or non-diversifiable risk. But we don't get paid for that, apparently. Let's have a look at that a little bit more in detail before we do the next two ratios. So I've drawn out the two lines here. We have our capital markets line and our security market line. They're the same thing. We have the same type of return, the risk-free rate. They're both faced with the same risk-free rate, except look at the x-axis. Here, this is total risk. Here, this is beta. And what we're going to do is we're going to plot these returns that we got and draw out new capital market lines. The portfolio, or the market, sorry, on the capital market line using the Sharpe ratio was 0.32. If we plot out each of the portfolios, Manager X had a 10% return. So if this is 9, here is 10. With 20% of market risk, here's the 20%. So it'd be right about there. So there is X. Y was 11 and 10. So there's 11 and here's 10%. So Y's portfolio would have landed right about there. And Z was 12%, was a higher return, but a significantly higher risk at 25% risk. So 25% at 12 would have placed us somewhere right around there. So let's go ahead and see if we can't connect those portfolios. There's X. Z is very close. You can see it's almost the same line, isn't it? And here is Y. So there we go. Our Y, and we know that it had a ratio of 0.80. Our Z was right here. It had a ratio of 0.36. And our X is down here, and it had a ratio of 0.35. So you can see from 0.32 to 0.35 to 0.36 all the way to 0.8. So we didn't even have to calculate anything. If we would have just plotted the returns for X, Y, and Z in return risk space, this whole quadrant, this is return, this is risk. In return risk space, we could have drawn out these lines, and it would have been easy to calculate the slope of each line as just simply the rise over the run. And we would have gotten 0.32, 0.35, 0.36, and 0.8. That is the Sharpe ratio. This is how this is the function of each line. We can calculate the expected return on any asset as a function of the risk-free rate plus the slope of the line times whatever the standard deviation of whatever we had was. And this is, each one of these is the slope of the line. Here's the deal. We can only find the expected return using the capital market line for efficient portfolios only. Remember, the capital market line connected the risk-free rate with the market portfolio. Everything along this line was just changing our weightings between the risk-free rate and the market portfolio. If we wanted to add a particular asset, remember what we needed. We needed the correlation or the covariance matrix of that security with every other security in that portfolio. This was a lot of work to do. So when we're looking at the expected return of a portfolio, we would use the capital market line if we're dealing with efficient portfolios only. Full stop. That does not mean that we can interpret the Sharpe ratio that way. Aha. That's the confusion that we run into, is that if this is used to price out efficient portfolios only, then we should measure the performance of efficient portfolios only using the Sharpe ratio. No, and we'll get to that. Let's move over to the trainer ratio, and let's plot the returns for this one on here. So we're not even going to look at what our ratios are. We're just going to see plotting the returns in risk beta space. This is return risk space. This is return beta space. Let's plot it in return beta space. X had 10% with a beta of 1.1. So there's 10%. Here's a beta of 1.1, and 10%. We're probably about there. Y had 11% with a beta of 0.7. So here's 11%. There's 0.7. We're probably about there. And Z was 12 and 0.6. So here's 12%, here's 0.6, would be about there. So let's anchor our point, and let's draw our lines through each one. These are security market lines, not capital market lines, right? So this was Z, Y, X. Now, to determine the slope of this line, our slope of the line is the expected return. Let's just be clear about what our slope is here. M is the expected return on the portfolio minus the risk-free rate over beta of the portfolio, because this is beta. So what did we get for X? 0.064. 0.064. The market was 0.06. Y was 0.114. 0.114. Notice the slope of the line is much, much steeper. And Z was 0.15. And again, if we plot it in return beta space, each of these agree with exactly what the trainer ratio is. The slope of the line gives us exactly what each ratio is. Now, why did we move from a capital market line to a security market line? Because it was difficult to price out a single security without having to find that covariance matrix with everything. It made more sense just to compare it with the market return and measure its systematic risk, because we said, hey, look, you're only going to get paid for systematic risk. So that we can use the security market line to find the expected return on any security. The capital market line is only useful for finding the expected return on efficient portfolios only. The security market line can find the expected return on all securities. However, when you interpret the trainer ratio and the Sharpe ratio, it is reversed. The trainer ratio is only suitable for measuring the performance on very well diversified portfolios only. Well, that causes some confusion, right? If this is used to find the expected return on efficient portfolios only, shouldn't it be used to measure the performance on efficient portfolios? Well, no. Let's think about this for a minute. What do we have over here? We have only systematic risk. Only systematic risk, which means in a very well-diversified portfolio, you've diversified away the idiosyncratic risk or the non-systematic risk, and all you're left with is systematic risk. So you want to compare it with just systematic risk, which is beta. You want to adjust a well-diversified portfolio which only contains systematic risk. You want to adjust that just by systematic risk. So that's why in the Trainer ratio, to use the Trainer ratio, you would use it on well-diversified portfolios only. However, the Sharpe ratio has a risk adjustment of total risk, which means if you have a less than well-diversified portfolio, it'll be captured in your standard deviation of returns. The standard deviation of returns will capture not only the systematic, but the non-systematic. It is suddenly a measure of your lack of diversification. So to measure your return on a less than diversified portfolio, you would want to adjust that return for total risk, not just systematic risk. So let's just be careful about the two. The capital market line is useful for finding the expected returns on efficient portfolios only. But the Sharpe ratio, which uses the capital market line, is used to measure the performance of less than efficient portfolios. So that kind of confuses students. They'll say, but I read over here this and I read over here that. It seems contradictory. Well, it depends on how you're using it. Are you using it to find the expected return? If you're using it to find the expected return, follow these rules. If you're using it to measure performance, on the other hand, the Sharpe ratio will give you all portfolios, even a well-diversified. It will give you all portfolios, but the Trainer ratio is for well-diversified portfolios only. Now, when I say all portfolios, you can use the Sharpe ratio for because it will be reflected in total risk. If you have an extremely well-diversified portfolio, the measure of standard deviation for that portfolio will reflect just systematic risk. The thing is, what if you don't? The standard deviation of that portfolio will reflect all risk, which means you want to adjust the return by all risk. I hope that that clears it up. If it doesn't, please leave some comments in the video below so that if I have to redo the video because I'm not clear enough, I'll at least know where the gaps are. Okay, we're not done on this example yet. We still have two more ratios to go through. We have our M squared and our Jensen's alpha. Again, the M squared does not rely on CAP-M. Jensen's alpha does rely on CAP-M. So M squared is to the Sharpe ratio as Jensen's alpha is to the Trainer ratio. Let's go ahead and calculate this. We have the return on the portfolio minus the risk-free rate here, 0.10 minus 0.03, adjusted for total risk. And it's the standard deviation on the market divided by the standard deviation of the portfolio, 0.19 over 0.2. Now we take off exactly what the equity risk premium was. The return on the market is 0.09 minus 0.03 will give us 0.065%. Sorry, I did that wrong. 0.65%. Not quite 1%, 0.65%. Anything positive means we have excess return. Anything positive is good. But now we're just adjusting that for risk. So that's a risk-adjusted return. Y would be its return, 0.11 minus 0.03. And it is 0.19 over 0.10 minus 0.09 would equal 9.2%. And Z is 0.12 minus 0.03, and it's 0.19 over 0.25. Notice the denominators here are using total risk. 0.09 minus 0.03 equals 0.84%. 0.84, not that great, right? Why? Total risk is big. And how about the market? Because to interpret these, we're going to need, well, we can interpret them directly, but to see that we can interpret them directly, let's just see what the market is. 0.09, 0.19 over 0.19, minus 0.09, minus 0.03. Well, these two terms are the same. This amounts to 1 equals 0. So the market gives an m squared of 0. Anything positive means excess return. Who is our winner here? Our winner is y. Same winner on the Sharpe ratio. The Sharpe ratio and m squared will rank portfolios exactly the same because they adjust everyone for total risk. Jensen, on the other hand, let's look at what happens here. It is the return on the portfolio. So for manager X, it's 0.10 minus everything in here is 0.03 plus, what's the beta on X? 1.1. And of course, the RM minus RF. Here, I'm not going to keep putting in 0.09 minus 0.03. Let's just put in the 0.06 and be done with it, right? Equals 0.40%. For Y, it is 0.11 minus 0.03 plus its beta was 0.7 times 0.06 equals 3.8%. Z is 0.12 minus 0.03 plus its beta was 0.6. 0.06 in here equals 5.4%. And to see that you can compare this directly, let's do the market. 0.09 minus 0.03 plus 1 times 0.06. So you'll have, I'm doing my brackets wrong, right? This will give you 0. So who's our winner over here? Z is our winner over here because we're only looking at systematic risk. And it's the same ranking as the trainer ratios because it's based on the same return generating model, which is CAPM. So just to sum up, here's our managers again. Here was their expected returns. Here's measures of total risk. We had the Sharpe ratio and m squared, measures of systematic risk only. Trainer ratio, Jensen. I shouldn't say measures of, performance based on total risk and performance based on systematic risk. 1, 2, 3, 4, we ranked them. We see when we consider total risk, Y was the clear winner. Why? Because Y took on the least amount of total risk and had a decent return. When we look at systematic risk only, Z was the clear winner. Y, Z had the lowest of the systematic risk, but still delivered return. When you're looking at systematic risk only, measures, trainer measures, Jensen's alpha for fully diversified portfolios only. Fully diversified portfolios only. If it's not fully diversified, anything else, you can use Sharpe or m squared because the extra risk above the systematic risk that you're taking on will be captured in the standard deviation measure. It will be captured. Beta only captures the systematic portion. If you've diversified it away, that's all you got to measure by. But if you haven't, you got to find some way to adjust for that extra risk. Looking at another application of CAPM, security selection. This time, we assumed homogeneous expectations earlier. Now we're going to say, well, now we have heterogeneous expectations so that not everybody has the same expectations of the future. So let's have a look at our security market line. This is our return beta space. So we have a security market line. Our market portfolio has a beta of 1 and an expected return of the return on the market. And we can price everything out on the security market line. It is priced, everything priced on the security market line is the return it should offer given the systematic risk that it has. That's all it's telling us. So if we have A with a beta of A, the security market line, which is based on the capital asset pricing model, will tell us what the required rate of return is on A given its systematic return. That's the return it should offer. And all securities that reflect the consensus view lie on the security market line. But you don't have to agree with that. You could look at the beta of A and agree with CAPM and look at the expected return on A and say, I don't agree with that. I think it's different. You can. And you can have differences in beliefs because of your beliefs on its future cash flows. Your belief on the systematic risk of that security, is that the right beta? Maybe it's not. Remember, beta is a historical derivation. We're using regression to find the coefficient on the term. The beta that we get is the slope of the line of best fit on a scatter plot between the return on the security and the return on the market. Going forward, you may say, you know what, that beta is wrong. You can disagree. So you can find, rather than rely on CAPM for the expected return, you can derive your own expected return using a pricing model. For instance, the price at period 1 plus the dividend at period 1 divided by what we're going to pay today minus 1 will give you some measure of return. You can use whatever you want to figure out what you think the expected return, the 1 period expected return. That's kind of a drawback of CAPM, is you're limited to 1 period returns. But there's a 1 period return right there. That's the price at the end of the period plus the dividends we received divided by what we pay today minus 1 will give us 1%. So perhaps going over here, now remember, this tells us what the return should be based on its systematic risk. You might do your research and say, no, A should return this much. B, you say, should return this much, and C, you think, should return this much. So how do we interpret that suddenly? Well, if A should return this much, but CAPM says given its risk it should return that, this is underpriced. As soon as we see that it's going to return more, A clearly is undervalued. So everything, once we figure out what we think it's worth, what we think the return will be, everything above the security market line tells us that we have a security that's undervalued. So we would buy A, maybe not buy B, the distance isn't great enough, but if we're holding C, maybe we want to get rid of C, or maybe we want to short C because everything under the line is overvalued. It's overvalued. Because C is sitting here on the security market line with an expected return at this level. We think C, even for the same beta, we think C is here and will have a much lower return. Maybe we question its future cash flows. We might not question its systematic risk, but we might question its cash flows. B, on the other hand, we're looking at the same level of risk. Same with A, the same level of risk, just different in terms of cash flows. We could also say for B, for instance, that, we have a measured beta here. We don't think it's going to be there. We think beta will be somewhere around here. So if you follow it up to the line, you can still say, the expected cash flows, everything will be the same. Beta will change. It will still change its expected return. That means you have expectations that are different than what the security market line would indicate it should be based on its systematic risk. The last application we'll look at is something called a security characteristic line. And this is really just a regression. And what are we regressing? We're looking at the excess return of a particular security over the risk-free rate versus the excess return on the market over the risk-free rate. We obtain a line of best fit, a least squares line, with a particular intercept and a particular slope. So let's interpret what all this means. This, by the way, is called the security characteristic line when we're looking at excess returns on a security versus excess returns on the market. The formula for Jensen's alpha looked like this: the return on a particular asset minus what it should have been based on the model, based on the return generating model. Anything positive is positive alpha. Well, we can rearrange these terms and it'll look like this, and I'm sure you can do the algebra to see how we got to this point. This term over here, this if on a regression, this would be called our dependent variable. It's dependent on all of this. Our dependent variable is up here. It's just the excess return on I. This is this term. Our independent variable is just the excess return on the market over the risk-free rate. The excess return here is this. Our intercept is Jensen's alpha, and our slope is beta, the slope of the asset in question. So that we don't have to worry about generating beta, then calculating Jensen's alpha. We can just do a regression straight away on every security that we come across. We can just
capture data for the last 2 or 3 years, measure the excess return, do a regression, it spits out some numbers. You can have software that does that quite easily. So every day you can have a printout of all of these alphas in order, and you simply just go down the list till you get to 0 and you draw a line. Everything above that 0 line is positive alpha. You select those securities or overweight those securities. They're targets for inclusion in your portfolio, or if you already have them, maybe overweighting them. And then anything below that line that you draw delivers negative alpha. So if we have it in our portfolio, deselect. If we cannot deselect and we have to hold it, then underweight. If we have a lot more flexibility than that, go ahead and outright short them. So it helps us arrive at something directly, because the output of this regression will give us Jensen's alpha and beta, bang, at the same time.